I really wish I could take my current mortgage and the interest rate and move it from this home to another home. Something I've been hearing a lot over the last couple years. What if I told you you might soon be able to do that? So you bought your home a few years ago when rates were 3-4%. You've grown your family, you've grown your equity. Maybe you want to downsize. You could stand to have more space or less, but you're not willing to do so at the risk of making an irresponsible move. You feel stuck. Congratulations, a lot of Americans feel that way. You don't want to change your standard of life by taking on a higher interest rate at a higher sales price. That's just fiscally irresponsible. So you stay in the house even though you want to move. That's what people are calling the lock-in effect. It's a term that's been coined over the last few years, keeping homeowners in their current homes. Now, imagine being able to move your current mortgage, same rate, same loan terms, into the next home. That's what the idea of a portable mortgage is all about. And that's what's getting serious attention in Washington right now. So what is it? A portable mortgage would allow a homeowner to carry forward their existing loan, including the interest rate and terms, when moving from one house to another. This isn't exactly a new concept, by the way, so it's being done in the United Kingdom, Australia, Canada. It just hasn't been done here in the United States. So why it matters? 73% of US mortgage borrowers have rates under 5% right now. Because of that, understandably, they're reluctant to sell, which has been called that lock-in effect that I referenced. This reduces housing supply and limiting inventory, which puts pressure on prices. But when surveyed, nearly half of homeowners, 47%, say they'd consider making a move if rates drop below 5%, which makes sense. A portable mortgage could unlock more movement, so people that are looking to relocate for a job or just upsize, downsize, and it could free up homes for new buyers. Let me share how it would work. A homeowner currently has a low rate, so let's say 3 to 4% on property A. They decide to sell and they want to move from property A to property B. Under portable mortgage arrangements, the homeowner transfers their existing loan, same principal balance, same interest rate, same terms, from property A to property B. If the purchase price of property B is higher than the outstanding loan balance on property A, the difference is handled in one of two ways. So the homeowner puts down cash to cover that difference or gap, or they take a second loan out at whatever the current market rate is to finance the extra amount. So they would have two payments. Idea is that those two payments would be reasonable. Qualification would still be required. The homeowner must meet lending and underwriting criteria, income, credit, property value for the move, but the homeowner retains the benefit of their low interest rate on that portion, which means their monthly payment for the transferred portion stays that low amount. And the new loan for the gap would be on today's rate. So there are some market implications. So for sellers, homeowners, if you're locked into a 3 to 4% mortgage, moving becomes less of a sacrifice, becomes less fiscally irresponsible. For buyers, more inventory becomes available if more people decide to move. There are some catch and downsides though. So implementation is not trivial. So the US mortgages are tied to properties. So moving a loan with you challenges the way that mortgage-backed securities work. Implementing portability requires restructuring. So how the loan is treated in the investor and servicer ecosystem. Another challenge is it only allows some homeowners, primarily those with existing low rates, the ability to do this. Renters or first-time home buyers still face today's higher rates, so it doesn't help that population. Also, it doesn't magically fix home price inflation or the supply shortage. It's a tool, it's not a silver bullet in fixing things. It could also disrupt liquidity in the marketplace because fewer mortgages will be paid back before the term. So there's a potential for higher rates and costs for future buyers because there's less money available because you're not paying back that loan, you're keeping it. While it would help, it does not immediately fix housing supply, home price inflation, or affordability for all. It offers increased flexibility for those who feel locked in their current home because of the low rates. There's also some legal structural issues that remain. So how do you securitize a loan that changes collateral from one house to another? What happens if a new property is more expensive? How do servicers track this? So there's some logistics that would have to be figured out before this becomes a reality. But why this matters, as somebody who works with clients, friends, family, this is a progress opportunity. If your goal has been to move, upgrade, adapt your home as your life changes, your kids grow, you want more space, you're relocating, you want to be closer to family, a portable mortgage idea means that you're not forced to stay put just because you have a great rate. It gives you some flexibility. It empowers real estate mobility, choice, and alignment with life goals. So the question I'll leave you with, if you had a 3 to 4% mortgage today, would you move if you could bring that rate with you? If you have any questions, want to see how this might work for you, feel free to reach out. Make it a great day.